Most people think a recession is the thing to fear. I do not. A recession is painful, but at least it is familiar. Markets fall, businesses slow down, unemployment rises. The Federal Reserve usually has a playbook. Rates come down, credit loosens, the pressure gets released somewhere. You may not enjoy living through it, but the system at least recognizes the disease. What worries me far more is the setup where the economy gets sick in two directions at once. Prices keep rising while growth goes nowhere. Jobs get shakier while the cost of living keeps climbing. The central bank wants to fight inflation, but the labor market is weakening. It wants to support employment, but prices are still too hot. Every move solves one problem by feeding another. That is when people stop feeling like the economy is slowing down and start feeling like the ground under their household is turning against them. That is the setup I want to talk to you about today, because something worse than an ordinary recession is beginning to take shape, and most families are not positioned for it at all. I have watched markets long enough to know that the danger usually does not arrive with a trumpet. It arrives as contradiction. You hear one expert tell you inflation is cooling. Another tells you growth is fading. Another tells you the labor market is weakening. Another tells you energy costs are sticky. Another tells you tariffs will pass through to consumers. Another tells you the Fed will have to cut. Another tells you the Fed cannot cut. When all of those statements can be true at the same time, you are no longer looking at a normal business cycle. You are looking at an economy that is beginning to lose the clean relationship between cause and effect. That is when ordinary investors get hurt the most, because most portfolios are built for simple environments. People build one portfolio for growth, or one portfolio for recession, or one portfolio for lower rates, or one portfolio for disinflation. Very few people build for the environment where inflation remains too high, growth remains too weak, policy remains trapped, and household confidence keeps getting squeezed from both ends. But that is exactly the environment I think you need to understand. I want to walk you through this the way I would explain it to a family member sitting across from me at the kitchen table first. What this setup actually is. Second, why so many economists are talking about it now. Third, what it does to your paycheck, your portfolio, and your margin for error. And finally, where I would want my money positioned if I believed this risk was real. Because once you understand how these pieces fit together, you stop asking whether the headlines sound scary and start asking a much more useful question. If this environment is already beginning, is my money standing in the part of the market most likely to get punished? Let us start with a simple definition, because a lot of people hear the word stagflation and treat it like an academic term. It is not. It is one of the few economic conditions that can reach directly into a household and damage almost every part of it at once. Stagflation is the ugly combination of three things happening together: slow or stagnant economic growth, high or rising unemployment, and inflation that does not come down the way policymakers need it to. That combination matters because the economy is not supposed to work that way for long. In the neat version of the textbooks, inflation and unemployment often pull against each other. A hotter economy can create more pricing pressure. A weaker economy can cool prices down. That does not mean it is always elegant, but the normal policy logic at least has a direction. Stagflation breaks that logic. The economy gets weaker, but prices do not get the memo. Businesses feel pressure, but households do not get relief. Consumers keep paying more while their job security gets worse. And the people running monetary policy find themselves stuck between two doors, knowing that opening either one can make the pain in the other room worse. That is why I do not describe stagflation as just another macro word. I describe it as the moment when the economy stops offering easy exits. If you want to understand what that means in real life, do not start with charts. Start with your own monthly expenses. Food, gas, utilities, insurance, housing, repairs, the ordinary things that are not optional. In a stagflationary setup, those costs keep pressing upward, while wages do not keep pace cleanly enough to offset the damage. Even if your income rises, it often rises more slowly than the things that matter most. That means your paycheck looks the same shape on paper, while its real purchasing power quietly shrinks underneath you. That is the first hit. The second hit is employment insecurity. When growth slows, businesses do what businesses always do. They get defensive, hiring freezes start, expansion plans get delayed, margins matter more, projects get cut. Workers who felt safe 6 months ago start hearing words like efficiency, restructuring, optimization, discipline, streamlining. Those words are often just polite ways of saying the environment is becoming less forgiving. So now you have the household under pressure from both directions. Daily living is more expensive. Future income is less certain. That is already hard enough. But the third piece is what makes stagflation so dangerous at the policy level. The Federal Reserve usually has one problem. It can lean against more clearly than the other. If inflation is the main enemy, it can tighten. If unemployment is the main enemy, it can ease. In stagflation, both enemies are standing in the room at once. Raise rates too aggressively to finish off inflation. And you can deepen the slowdown, hurt hiring, and crack more balance sheets, cut rates too early to support jobs, and you can reignite inflation, weaken discipline, and tell the market that price pressure will be tolerated. That is the policy trap. And once you understand that trap, you can see why this environment is more dangerous than the average recession scare. In a recession, the system usually knows which lever it wants to pull. In stagflation, every lever comes with a cost the public can feel very quickly. That is why I want you to take this seriously. Now, not because I know the exact month or the exact quarter when the pain shows up most clearly, but because by the time the average household can feel it with complete certainty, asset prices usually have already repriced, defensive positioning is already more expensive, and the easy decisions are gone. Now let me tell you why this conversation is happening with so much force. In 2026, a lot of people want a single villain. They want one chart, one number, one headline, one person, one vote, one war, one policy mistake. The economy almost never gives you the courtesy of one villain. What it usually gives you is a collision. And what worries economists right now is a collision between geopolitical pressure, policy pressure, structural pressure, and market expectations that were built for a much cleaner outcome. The first part of that collision is tariffs. Tariffs sound abstract until they hit the shelf price. Many people like to talk about tariffs as if they are a patriotic slogan or a negotiating tactic. Markets do not care about slogans. Consumers do not buy slogans at the grocery store. Businesses do not build their cost structures around speeches. Costs go somewhere, and increasingly, those costs get passed through. That means import costs become consumer prices. It means businesses facing higher input costs either take a margin hit or push the price burden outward. It means inflation does not have to come only from wages or from an overheating labor market. It can come from policy friction that raises the cost of goods directly. That matters because when a household is already stretched, it does not need inflation to explode to feel damage. It only needs inflation to remain stubborn in the categories that matter most. Now add the second force, which is energy and geopolitical instability. There is a reason oil shocks have always terrified policymakers. Energy is not one line item. It is a transmission system. If oil remains elevated because of war risk, shipping risk, supply risk, or persistent geopolitical tension, that higher cost works its way through transportation, manufacturing, logistics, food production, travel, and the psychology of consumers themselves. Higher energy prices do two ugly things at once. They lift costs across the economy and they behave like a tax on consumers who must spend more simply to maintain the same daily life. That is textbook stagflation pressure. Prices rise while demand weakens. Inflation persists while growth gets squeezed. Now add the third force, the one that makes central bankers lose sleep. The labor market is no longer strong enough to ignore. If unemployment rises and weakness spreads, the pressure on the Fed becomes obvious. Do something, support demand, protect jobs. Keep the slowdown from turning into a deeper contraction. But inflation has not cooperated enough to make that decision easy. If core inflation remains too sticky, the Fed cannot relax with confidence. So now policymakers are trapped between the optics of a weakening labor market and the reality of price pressure that is not fully dead. That is not an elegant environment. That is the kind of environment where markets are forced to guess not only what the economy will do, but what policymakers will tolerate. And guessing games get expensive very quickly. Then there is the structural fog that makes everything harder to read for a while. Investors were sold a clean story. Artificial intelligence would unleash productivity, growth would accelerate, margins would expand. A new technological cycle would help justify lofty valuations and carry the market into a stronger future. I am not dismissing the long-term potential of AI. I am simply saying that timing matters. A productivity revolution that arrives too slowly does not help a household dealing with inflation today. A technology boom that has not yet translated into broad enough efficiency gains does not solve a labor market problem this quarter. And a market that priced in tomorrow as prosperity too aggressively can still punish investors badly in the present if the real economy does not deliver on schedule. Add demographics to that picture, and the situation gets murkier, not cleaner. Slower immigration and an aging population can create labor shortages in some places, rising dependency burdens in others, and a growth profile that is weaker than policymakers would like. Some sectors cannot find enough workers. Other sectors cannot maintain enough demand. That does not create a smooth economy. It creates mismatches. And all of this unfolds with one more background pressure that a lot of people ignore until it becomes impossible to ignore: fiscal strain. When interest costs on federal debt move closer to the economy's own growth rate, the math of rescue becomes less forgiving. The government still has tools, of course. Governments always have tools. But the cost of using them rises, the room for error shrinks. Spending your way out of weakness becomes politically and economically harder when inflation is still a live threat. And debt service is already eating more oxygen. So step back and look at the whole picture. tariffs pushing prices, energy pressure, keeping costs high, a labor market that is weakening enough to frighten policymakers, inflation that is sticky enough to restrain them, a technology story that may be real in the long run but is not solving everything fast enough. Now, demographic imbalances, fiscal stress, that is not one problem, that is a setup. And setups are what matter in investing. Because markets do not wait for the final diagnosis. They begin adjusting when the direction of risk becomes harder to ignore. So what does this environment actually do to ordinary investors? This is the part where I want to be very direct. Because vague fear is useless, specific pressure is what you need to understand. The first casualty is purchasing power. If your money is parked in places that do not adapt well to inflation, or your income is not growing fast enough, you start losing ground even if you think you are being conservative. Many people believe they are safe because they are not taking obvious stock market risk. What they miss is that inflation itself is a form of portfolio damage. If your dollars buy less year after year and your assets are not keeping up, you are losing wealth in quiet motion. The second casualty is confidence in long-duration promises. Assets that depend heavily on low rates, distant growth, and generous valuation multiples tend to suffer when inflation stays high and rates stay restrictive. That includes many long-term bonds and a large portion of high-growth equities whose value rests heavily on cash flows expected far in the future. When rates stay higher for longer, those future dollars get discounted more harshly. When inflation remains sticky, fixed returns become less attractive. When growth slows, optimism about future expansion loses some of its magic. That is why stagflation is such an ugly environment for investors who are overloaded with duration, whether they realize it or not. A long bond is duration, a richly valued growth stock is duration, a business price for perfect execution many years into the future is duration. If the environment turns hostile to duration, it does not matter that the story sounded wonderful on television. The market can still mark those assets down and keep marking them down longer than most people expect. The third casualty is flexibility. When households get squeezed by higher living costs and shakier employment, they lose room to think clearly. Investors who needed their portfolios to behave one way discover that their expenses are behaving another way. They plan for modest inflation and steady employment, not for food, insurance, gas, and utilities to climb while the labor market gets less friendly. That is when people sell what they should have held and hold what they should have reduced. Not because they are foolish, because they were never told to build a portfolio for a world where inflation and stagnation arrive together. Now, if I believed this risk were real, where would I want my money? I would start with a principle, not with a ticker. In stagflation, I want to own things that either adapt to inflation, throw off real cash flow, or sit close enough to short-term reality that they are not badly damaged by a world of persistently higher rates. I do not want to be too clever, I want to be durable. That leads me to several categories. The first is commodities and commodity. Linked exposure, I am not talking about a casino mentality. I am talking about the reality that when prices for raw materials rise, the underlying commodities often respond differently from the broad financial assets that inflation hurts: energy, metals, agricultural products. And related exposures can behave as a kind of pressure valve when inflation is embedded in the real economy rather than confined to asset speculation. If inflation is being transmitted through energy and supply costs, some commodity exposure can help offset the damage elsewhere. It will not be smooth, it will not be pretty, but it is aligned with the actual source of the pressure. The second category is real assets, especially real estate, that can maintain usefulness, pricing power, and long-term relevance. I have always preferred assets I can understand: a productive business, a useful piece of land, an apartment building in the right market, a property with durable demand. When inflation rises, real estate has historically offered a partial shield because replacement costs rise, rents can adjust over time, and the asset itself remains tied to real-world need rather than pure financial abstraction. That does not mean all real estate is safe at all times. Financing matters, location matters, leverage matters, cash flow matters, but I would still rather think about a useful real asset than rely exclusively on a paper promise that gets weaker. As inflation stays sticky, for investors who do not want direct property exposure, I understand the appeal of publicly traded real estate vehicles, but I want to make the distinction carefully. Real estate can be a hedge. Highly leveraged real estate in the wrong environment can be a problem. The point is not to own the label. The point is to own assets with durable utility and the capacity to reprice over time. The third category is defensive businesses. In a world where households pull back, the businesses I trust more are the ones that sell what people must keep buying: utilities, healthcare, consumer staples, the ordinary essential parts of life. These businesses may not excite the crowd in a mania, but that is not the job I need them to do in a stagflationary setup. I need resilience, I need pricing power, I need demand that does not disappear simply because consumers have become more cautious. A company that can raise prices, carefully maintain cash flow, and keep serving essential demand is a very different animal from a company priced on hope alone. The fourth category is inflation, linked government instruments. There are environments in which I do not want to pretend nominal safety is real safety. If inflation is the enemy, then an instrument linked to inflation at least acknowledges the problem. Honestly, bonds, tips, and similar tools can help preserve purchasing power in a way that ordinary fixed nominal returns may fail to do when inflation surprises on the upside or remains elevated longer than investors expected. The fifth category is value-oriented equities with strong cash generation and real-world relevance. This is very different from buying whatever looks statistically cheap. I am not attracted to garbage simply because it has fallen. I want established companies that generate cash, allocate capital sensibly, possess some degree of pricing power, and are not entirely dependent on a fantasy multiple to justify ownership. If growth gets repriced and long-duration enthusiasm fades, value can regain the kind of respect it loses in speculative periods. Not always overnight, not cleanly, but structurally. It is better aligned with an environment where cash flow matters more than promises. And then there is one category I think a lot of people underestimate right now, very short-term government debt. When uncertainty rises, I do not mind giving up some excitement in exchange for resilience and optionality. Short-term treasury bills, direct ladders of short maturities, or vehicles that stay close to those maturities can provide something investors underestimate in hard environments, dry powder that still earns something that matters. A lot of people confuse activity with wisdom. They want every dollar in motion all the time, always chasing the next narrative. But in a world where long-duration assets may be vulnerable and the policy path is unclear, optionality is an asset in itself. Being able to wait, reassess, and redeploy from a position of strength is enormously valuable. That is why I would look very carefully at long-term bonds right now. This is where many conservative investors get blindsided. They think bond means safe. It depends which bond, at what maturity, bought at what yield, under what inflation environment. Long-term bonds are highly sensitive to rate expectations and inflation risk. If rates stay higher for longer, or if inflation keeps the market from believing in imminent relief, long-duration bonds can suffer far more than people expect from something they thought was supposed to be stable. That does not mean every bond is bad. It means you need to understand what kind of exposure you own. A1 to 3. Month Treasury bill is not the same creature as a long-term bond fund bought for yield reach in the wrong environment. A lot of investors need to review that distinction very carefully. The same goes for growth exposure. If your portfolio is overloaded with long horizon, high multiple technology heavy positions, you should at least be honest with yourself about what environment those positions need in order to behave well. They generally prefer lower rates, higher confidence, abundant liquidity, and a market willing to pay generously today for profits that may arrive years from now. That is not the environment stagflation rewards. Now, if you're 25 years old, earning steadily, adding capital every month, and you have a long runway, you can survive more volatility than most people think. Time is a beautiful asset. It gives you the ability to endure temporary mispricing and keep compounding. But if you are closer to retirement, already in retirement, or relying on portfolio withdrawals, then sequence matters much more. A bad few years in the wrong asset mix can hurt you. In a way, a 20-year-old simply does not experience. That is why this conversation is not really about being bearish or bullish. It is about matching the portfolio to the environment. If inflation stays troublesome, if growth weakens, if the Fed remains trapped, and if long-duration optimism gets punished, then the question is not whether your favorite stock story still sounds good. The question is whether your money is overexposed to the exact conditions that are deteriorating. This is where investors need to grow up a little. Every cycle tempts people to ask for a single perfect answer. There is not one. There is only better alignment and worse alignment, better balance and worse balance, better odds and worse odds. If I were making immediate decisions in response to this setup, I would ask myself a series of blunt questions. How much of my money depends on falling rates to work well? How much of it depends on rich valuation multiples staying rich? How much of it is tied to sectors whose cash flows live far in the future? How much of it is protected if inflation runs hotter than expected? How much of it is resilient if unemployment rises and consumer confidence weakens? How much of it is liquid enough to give me options without forcing me to sell risk assets at the wrong moment? Those are not glamorous questions. They are serious questions, and serious questions are usually what protect families. One of the great mistakes investors make is to assume that the economy must choose one clear path, either recession or recovery. Either inflation or disinflation, either growth or slowdown. Real life is much messier than that. The market can give you weak growth and sticky inflation together. It can give you asset volatility and high living costs together. It can give you political pressure, war pressure, fiscal pressure, and policy confusion, all at once. When that happens, the investor who survives best is usually not the one with the boldest opinion. It is the one with the strongest structure. That is the idea I want to leave you with. Structure first, prediction second. I do not need to predict the next headline perfectly to know that some portfolios are too fragile for the current setup. I do not need to know the exact date of the next policy move to know that long bonds and speculative growth can be vulnerable if inflation remains too sticky. I do not need to know whether every recession call is correct to recognize that households are already feeling the squeeze of rising costs and rising uncertainty. That is enough to act intelligently, not recklessly, not dramatically intelligently. You review the long duration risk, you check whether you have too much growth concentration, you make sure some part of your assets can live with inflation rather than be destroyed by it. You favor businesses with cash flow, durability, and pricing power. You keep some short-term government exposure because optionality is worth a great deal when the future is cloudy. You remember that a portfolio is not a social media post. It does not need to sound exciting. It needs to survive reality. Because if this really is the worst kind of setup, a world where prices stay high, growth stays weak, policy stays trapped, and confidence keeps eroding, then the biggest mistake will not be missing some speculative upside. The biggest mistake will be standing in the exact part of the market that needs a perfect economy when the economy is offering anything but perfection. That is the test. Not whether you can impress anyone with your market opinions, not whether you can memorize the latest macro buzzword, not whether you can guess the Fed meeting 3 months from now. The real test is simpler. If the next few years bring sticky inflation, slower growth, and a market that punishes long-duration optimism, is your money built to endure that world? Or is it still dressed for the world investors wanted? Instead, that is the threshold I would force myself to face, and I would face it now, while choices are still voluntary rather than later when the market starts making them for me.